Welcome to this presentation by Facilitators Research. This research is distributed exclusively for informational and educational purposes and does not constitute financial, legal, tax, or investment advice. For such services, you may reach out to speak to one of our officers.
Lesotho, a small open economy pegged to the rand, dependent on customs receipts and budget support. For over 2 decades, its interest rates and inflation have shaped every fiscal decision the National Treasury has made. This is the fiscal policy view. 5 periods. 5 sets of decisions. How should the Ministry of Finance and Parliament have calibrated spending, borrowing, and reserves in each 5-year window to protect the public purse? 23 years of monthly data from the Central Bank of Lesotho and the Bureau of Statistics. 11 interest rate series, covering every cost of debt instrument the Treasury uses. CPI inflation, the driver of expenditure pressure. All numeric, all verified at source. For a finance minister, the real interest rate sets the true cost of servicing debt. Inflation sets the erosion of revenue purchasing power. Together, they define the fiscal space. The framework for fiscal strategy. 3 forces shape the budget. Interest rates set the cost of servicing government debt. Inflation sets the growth path of expenditure, especially salaries and subsidies. The real rate, nominal rate minus inflation, sets the true burden of borrowing. When the real rate is high, debt service drains the budget. The Treasury must run primary surpluses and borrow less. When the real rate is low or negative, debt is cheap. The Treasury can invest. Period 1. 2002 to 2006. The policy rate fell from 16 to 11%. Inflation rose from 3 to 6. The real rate averaged 7.5%, peaking at 9.6 in 2005. For the Treasury, this was an expensive debt window. Real borrowing costs were among the highest in the series. Every loti of debt issued carried a heavy real burden. The T-bill rate averaged 8.7%. Debt service consumed a growing share of revenue. With a 7.5% real rate, the Treasury strategy is fiscal consolidation. Run primary surpluses. Cap recurrent expenditure. Limit new borrowing to infrastructure with returns above the real rate. Build the reserve buffer at the central bank. The P&L shows revenue growth tracking nominal GDP, but expenditure must be held below it. Comprehensive income includes valuation losses on long bonds as yields fall. The aspiration is a debt-to-GDP ratio falling, not rising. Discipline dominates. Period 2. 2007 to 2011. The global financial crisis. Inflation spiked to 10.7% in 2008, then collapsed. The policy rate fell from 13 to 9%. The real rate compressed to 4.3%. For the Treasury, the crisis cut both ways. Revenue from customs and mining remittances fell. But lower real rates eased the debt burden. Countercyclical spending on social protection was needed but constrained by falling receipts. With real rates compressing and revenue volatile, the Treasury strategy is countercyclical but cautious. Allow the deficit to widen temporarily. Issue long bonds to lock in falling yields. Protect social spending. The P&L shows revenue weakness offset by lower debt service. Comprehensive income benefits from revaluation gains as bond yields fall. The aspiration is a deficit below 3% of GDP, with debt stabilizing. Parliament approves a crisis contingency fund. Flexibility dominates. Period 3. 2012 to 2016. Rates stabilized around 10%. Inflation drifted from 6 to 3, then back to 6. The real rate recovered to 4.7%. For the Treasury, this was a normalization window. Revenue recovered with the commodity cycle. Debt service stabilized. With stability and a 4.7% real rate, the Treasury strategy is balanced consolidation. Cap recurrent expenditure growth at inflation. Redirect savings to capital investment. Lengthen debt maturity to reduce refinancing risk. The P&L shows revenue growth outpacing debt service. Comprehensive income is stable. The aspiration is a primary surplus of 1 to 2% of GDP and debt below 40%. Parliament enacts a fiscal responsibility law. Discipline returns. Period 4. 2017 to 2021. The policy rate hit its all-time low of 7.2% in 2020. Inflation rose modestly from 5 to 6. The real rate compressed to 2%, then turned negative for 32 months starting May 2020. For the Treasury, this was the cheapest debt window in the series. Real borrowing costs were negative. The COVID emergency required massive spending. But the cost of financing it was historically low. With negative real rates, the Treasury's strategy is countercyclical expansion. Borrow and invest. Issue long bonds to lock in negative real yields. Expand health and social protection spending. Fund infrastructure. The P&L shows a large deficit, but debt service as a share of revenue falls because yields are so low. Comprehensive income benefits from bond revaluation. The aspiration is debt rising to 50% of GDP temporarily, with a credible consolidation path post-crisis. Parliament approves emergency powers. Investment dominates. Period 5. 2022 to 2024. Inflation peaked at 8.3%, then fell to 6. The policy rate rose from 10 to 11. The real rate recovered to 4.8%. For the Treasury, the window normalized. The era of free money ended. Debt service costs rose with higher yields. But the real burden remained moderate at under 5%. The Treasury that borrowed long during COVID now faces manageable refinancing. With real rates back above 4%, the Treasury strategy is gradual consolidation. Cap new borrowing. Refinance short-term debt into longer tenors while yields are still moderate. Rebuild the reserve buffer. The P&L shows revenue growth from economic recovery, but debt service rising. Comprehensive income is neutral. The aspiration is debt stabilizing at 50 to 55% of GDP, with primary balance restored by 2026. Parliament passes a medium-term fiscal framework. Normalization dominates. This heat map shows every year from 2002 to 2024. The top row is the policy rate, the cost of debt. The middle row is inflation, the expenditure driver. The bottom row is the real rate, the true borrowing burden. Green means the real rate is high, forcing consolidation. Red means it is low or negative, allowing expansion. The pattern is clear. Lesotho's expensive debt years were 2003 to 2006. The cheap debt window was 2020 to 2022. That was the signal to invest. 5 periods. 5 fiscal strategies. The data tells the story. The Treasury that tracked the real rate, consolidated during expensive debt windows, invested during cheap money, lengthened maturities, and rebuilt reserves would have kept the public purse solvent and credible across the full 23-year cycle. The evidence is in the numbers. The framework is in the real rate. The decision is Parliament's.